In this lesson, you'll learn what earnings per share is, why investors should know about it, how it's calculated, how you can roughly value a company using it, and what I look for when investing in stocks. Earnings per share, or sometimes just EPS. It's probably the most spoken about metric in finance. But what is earnings per share? And why is it such a focus for analysts and investors? In the previous lesson, we learned about net profit after tax. It's the profit of the company after you subtract all costs and expenses. It's the money the company can use to pay off debt, reinvest back into the business, and pay dividends to shareholders. So what is earnings per share? First, what is a share? If you're watching this video, I'm certain you know of or have heard about shares. But still, some people get confused about what they are. Shares represent ownership of a company. If you own a share of a company, you are one of its owners. Let's say I want to buy a pizza business. The business will be owned by a company. The business costs $100,000, but I only have $10,000. I decide to go out to all my friends and ask them if they want to join me in this business venture. I offer to give them 10% ownership of the business if they give me $10,000. I find 9 investors. I sell 9 shares of the company for $90,000 and invest $10,000 myself, so there are 10 shares that make up the company. If one of these investors wants to sell their ownership of the company, they will sell their share. This is exactly the same for public companies. The numbers are just a lot bigger. Apple has over 15 billion shares outstanding. So what does this have to do with earnings per share? Earnings per share tells you how much earnings or profit a share is entitled to. Let's say after 1 year, our pizza business makes $100,000 in net profit after tax. What is the earnings per share? To calculate earnings per share, we simply divide the net profit by the number of shares outstanding. The net profit is $100,000. There are 10 shares outstanding. The earnings per share of the company is $10,000. 100,000 divided by 10 equals 10,000. What is the earnings per share of Apple? Over the past 12 months, Apple generated just over $100 billion in net profit. There are around 15.5 billion shares outstanding. That means over the past 12 months, Apple had an earnings per share of about $6.50. 100 billion divided by 15.5 billion equals around 6.5. What does this mean? It means if you owned 1 share of Apple, you would be entitled to $6.50 of the net profit. If you owned 100 shares, you would be entitled to $650. Whether you get this money is up to the board of directors, but as a shareholder, it is essentially yours. Why is this an important number to calculate? Because the value of the company is tied to the earnings it can produce. My pizza company currently earns $10,000 per share. Remember I said the owners could sell their ownership by selling their share? Well, how much would you be willing to pay for 1 share in this company? The amount you're willing to pay would depend on the return you want from the investment. Let's say you want a 10% return per year on your investment. Let's assume the company will continue to make $10,000 in earnings per share per year. If the company is making $10,000 per share per year and you want a 10% return, that means you would be willing to pay $100,000 for 1 share of this company. How did I work that out? I simply divided the earnings per share by my required return. 10,000 divided by 10% equals 100,000. What if you wanted a 15% return? You would be willing to pay $66,667. 10,000 divided by 15% equals $66,667. What if the earnings per share went up to $20,000? Well, if you are still happy with a 10% return, you would be willing to pay $200,000 for a share. $20,000 divided by 10% equals $200,000. What do I look for when investing in stocks? I look for companies that are consistently growing their earnings per share over time. If a company can consistently grow its earnings per share, the market should reward it by driving up its share price. You can look at the stock chart of just about any company and it will show the same thing. Here's the EPS for Coca-Cola. And here is its share price. Here is the EPS for Apple. And here is its share price. Here is the EPS of Microsoft. And here is its share price. It works the other way too. Failure to grow EPS will result in a lower share price. Just look at Warner Brothers, Walgreens, and Beatrice. One more useful thing about earnings per share is it is used to calculate the price to earnings ratio, or PE ratio. The PE ratio is the most widely used metric to value companies, but we will get to that in a later lesson. Let's summarize. A share represents ownership of a company. Earnings per share tells you how much net profit each share is entitled to. You can value a company by applying your desired rate of return to the earnings per share. I look for companies that consistently grow their earnings per share over the long term. If a company can consistently grow its earnings per share over the long term, it should be rewarded with a higher share price.
For more videos on investing, follow Value Theory or go to valueinvestoracademy.com.